Two investors, same age, same income, same exact index funds, same exact contribution amount every month. 30 years later, one has $387,000 more than the other. Not because of better stock picks, not because of market timing, because of where they held those identical funds. One put their total stock market fund in their Roth IRA. The other put it in their taxable brokerage account. That one decision cost $87,000 over 3 decades. This is the single most expensive investing mistake I see, and 60% of portfolios I've reviewed have it right now. The worst part? Most people set this up once at 25 and never check it again. They're bleeding tax money for 40 years without realizing it. I'm Kevin. This is Prosperity Levels. Today I'm showing you the 5-minute check that identifies this mistake, the math behind that $87,000 number, and exactly how to fix it without triggering capital gains. By the end, you'll know if you have this problem and how to solve it this weekend. Let's check your portfolio. The mistake is called asset location, not allocation. Location, where you hold your investments, matters as much as what you invest in. Most investors know about asset allocation: 60% stocks, 40% bonds. Diversification, risk tolerance, that's allocation. Asset location is different. It's about which specific funds go in which specific account types. Taxable brokerage versus Roth IRA versus traditional 401,000. Here's what most people do wrong. They pick good index funds, low expense ratios, proper diversification. Then they put them in completely backwards accounts. They put dividend-heavy funds in taxable accounts where every dividend gets taxed. And they put tax-free municipal bonds in Roth IRAs where the tax-free benefit is wasted. Let me show you the most common version of this mistake. Total stock market index fund in a taxable brokerage account. Total market funds are excellent investments. Low cost. Broad diversification. I own them, but they distribute dividends every quarter, about 2% annually. In a taxable account, those dividends are taxable income. Every single year, for decades. You can't avoid it. You don't get to choose. The fund distributes, you pay tax. On a $100,000 position generating $2,000 in annual dividends, you're paying $300 to $500 in taxes every year, depending on your bracket. That same fund in a Roth IRA, zero taxes. Ever. Dividends reinvest tax-free. Growth compounds tax-free. Withdrawals in retirement, tax-free. The fund is identical. The returns are identical. But the tax outcome over 30 years is $87,000 different. 60% of portfolios I've audited have at least one version of this mistake. High dividend funds in taxable, REITs in taxable, bond funds in taxable, all generating ordinary income taxed at your highest marginal rate. Year after year, completely avoidable. Why is this so common? Because nobody teaches asset location. Every beginner investing guide talks about what to buy. Almost none talk about where to hold it. You open a Roth IRA at 23. You open a taxable brokerage at 27. You start a 401,000 at 30. Each time you pick good funds. But nobody ever said the fund choice should be different based on the account. So you buy the same total market index fund in all 3 accounts. Because it's a good fund, and it is, but that doesn't mean it belongs in every account type. The second reason this happens, tax-advantaged accounts have contribution limits. Roth IRA maxes out at $7,000 per year. You have more money to invest than that, so the rest goes into your taxable brokerage. And you buy the same funds you already own, because they're working, because you understand them, because consistency feels smart. But tax efficiency doesn't care about consistency. It cares about which income gets taxed where. The third reason, immediate tax pain is invisible. You don't write a check for dividend taxes. It's withheld automatically or paid at year-end with everything else. You never see the bleeding. You just see your account balance grow slower than it should. And you assume that's just how investing works. It's not. Let me show you the math. Here's the scenario. Investor A and Investor B both invest $100,000 in a total stock market index fund. Both hold for 30 years. Both earn 8% average annual return. Investor A holds it in a Roth IRA. Investor B holds it in a taxable brokerage account. Same fund, same timeline, different location. The fund generates 2% in annual dividends. That's $2,000 per year on a $100,000 position. Initially, Investor A in the Roth IRA, those dividends reinvest tax-free. No tax bill, ever, full compounding. Investor B in taxable, dividends are qualified, so taxed at 15% federal for most people. That's $300 per year, plus state taxes in many states. Let's call it $350 total. $350 per year doesn't sound catastrophic. That's the trap. It's not the annual cost. It's the compounding cost. Over 30 years, Investor B pays roughly $14,000 in dividend taxes. But the real cost is what that $14,000 would have become if invested. $14,000 invested over 30 years at 8% grows to $58,000. That's opportunity cost number one. Opportunity cost number two? The reduced compounding from paying taxes instead of reinvesting fully. After 30 years, Investor A's Roth account is worth $1,006,000. Investor B's taxable account, after all taxes paid, is worth $919,000. The difference? $87,000. Same fund, same contributions, same returns, different account location. And that's just on $100,000 with the 2% dividend fund. If you're holding a high dividend fund yielding 4%, or REIT yielding 6%, the cost doubles or triples. This is not a small mistake. This is a legacy-altering mistake. And you can check if you're making it in 5 minutes. Here's the 5-minute audit. Open every investment account you have. Roth IRA, traditional IRA, 401,000, taxable brokerage, all of them. Make a simple 2-column list. Column 1, account type. Column 2, funds held. Now check each fund for one thing. How much income does it distribute annually? Dividends, interest, capital gains distributions. Your brokerage website shows this. Search for the fund ticker, click details, look for distribution yield or dividend yield. It'll say something like 1.5% or 4.2%. Write that number next to each fund. Now, you can see the problem instantly. Any fund in your taxable brokerage account with the distribution yield above 2%. That's a location problem. Any bond fund in your taxable account? Location problem. Bonds generate interest taxed as ordinary income. That's your highest tax rate. They belong in IRAs. Any REIT fund in taxable? Major location problem. REITs distribute income taxed as ordinary income, plus they're required to distribute 90% of income annually. Tax nightmare in taxable accounts. Now flip it. Look at your Roth IRA and traditional IRA. What's in there? Do you have growth stocks that pay zero dividends? Do you have municipal bonds generating tax-free interest? Do you have index funds with sub 1% yields? If yes, those are backwards. You're wasting the tax advantage of the retirement account on investments that are already tax efficient. Municipal bonds are tax-free everywhere. Holding them in a Roth is redundant. They belong in taxable, where the tax-free status actually provides value. Growth. Stocks with no dividends generate zero taxable income until you sell. In taxable, you control the timing. In a Roth, the tax benefit is wasted because there's nothing to shelter. Here's the rule. Tax-inefficient investments go in tax-advantaged accounts. Tax-efficient investments go in taxable accounts. Tax-inefficient means high distributions. Bonds. Dividend-focused funds. REITs. Actively managed funds with high turnover. Tax-efficient means low or zero distributions. Index funds with low dividend yields. Growth stocks. Municipal bonds. I-bonds. If your current setup is backwards and statistically, 60% of you just discovered it, here's how to fix it. Do not panic sell everything in your taxable account. That triggers capital gains taxes today. You'll replace one tax problem with a bigger immediate one. Fix this gradually using 3 strategies. Strategy 1. Redirect future contributions. Stop adding money to the wrong funds in the wrong accounts. Starting today, new contributions go to the optimized locations. If you're contributing to a Roth IRA, buy the high dividend funds. They're total stock market, dividend aristocrats, bond funds, REITs. If you're contributing to your taxable account, buy the tax-efficient funds, S&P 500 with low yield, growth-focused index funds, individual growth stocks if that's your strategy. Over time, this naturally rebalances your portfolio toward optimal location without triggering any taxes. Strategy 2. Balance inside tax-advantaged accounts first. If you have funds in your IRA, or 401,000 that should be in taxable, sell them inside the retirement account and buy what should be there. There are zero tax consequences inside IRAs. You can trade freely. This is the fastest fix for half the problem. Swap your Roth IRA holdings to the tax-inefficient funds immediately. No taxes, no penalties, just better positioning. Strategy 3. Tax loss harvest in taxable to swap strategically. If you have positions in taxable that are at a loss or small gain, you can sell and immediately replace with a more tax-efficient alternative. Sell a total stock market fund at break-even. Buy an S&P 500 fund with lower dividend yield. Virtually identical exposure, better tax efficiency going forward. If the position has large gains, leave it for now. Fix everything else first. Then decide if the tax cost is worth the swap based on how long until retirement. Let me give you a specific example. You have 50,000 in a total stock market fund in taxable. It's up 20%. 12,000 in gains. Selling triggers 12,000 in capital gains. At 15%, that's 1,800 in taxes. Is it worth it? Run the math. If you're 30 years from retirement and the tax drag is 500 annually, you'll pay 15,000 over 30 years in unnecessary taxes by holding. Paying 1,800 today to save 15,000 over time is worth it, but if you're 5 years from retirement, maybe not. Context matters. The safest fix: redirect contributions now, rebalance inside IRAs immediately, and gradually optimize taxable over the next few years as opportunities arise. You don't have to fix everything this weekend. You just have to stop making it worse and start moving in the right direction. One more critical point: asset location is most valuable when you have both taxable and tax-advantaged accounts. If everything is in a 401,000, this doesn't apply yet. But the moment you open a taxable brokerage or Roth IRA alongside your retirement accounts, location becomes critical. Let me recap the 5-minute check. List all accounts. Write down what's in each. Note distribution yields. Flag anything tax inefficient in taxable accounts. Flag anything tax efficient in retirement accounts. You just identified the problem. The fix: redirect future contributions. Swap inside retirement accounts immediately. Gradually optimize taxable without triggering unnecessary gains. 60% of investors have this mistake right now. Over 30 years, it costs between $50,000 and $150,000 depending on portfolio size. The reason it persists? Nobody teaches this. Investing education focuses on what to buy. Almost nobody talks about where to hold it. But location is just as important as allocation. Same funds, different locations. 900,000 versus 1 million after 30 years. This is one of the easiest high-impact optimizations in all of investing. No stock picking required. No market timing. Just putting the right funds in the right accounts. Go run the 5-minute check this weekend. Look at what you're holding and where. I guarantee 60% of you find at least one location mistake. Drop a comment with what you found. Are your dividend funds in taxable? Bonds in a brokerage account? Municipal bonds wasting space in a Roth? I read comments and I'll tell you if it's worth fixing or if your setup is already optimized. Next video: the Roth conversion mistake costing high earners $230,000. Most accountants won't bring this up because it's complicated and they bill hourly. Subscribe and turn on notifications so you don't miss it. I'm Kevin. This is Prosperity Levels. We find the expensive mistakes hiding in plain sight and show you exactly how to fix them. Go check your portfolio. 5 minutes could save you $87,000.